Are you wondering how much you can pay into your pension? Perhaps you're thinking of paying into someone else's pension on your behalf, such as a spouse or child, and if so, how much? Hello and welcome to the channel. My name's Alex and I'm an independent financial advisor. In this video, we'll look at the rules around defined contribution and defined benefit pensions, and I'll also touch on the limits around pension contributions at whatever stage of life you're at. If any of these don't apply to you, you can use the timestamps and chapters on the video to simply skip ahead. Technically, there's no limit to the amount that you can put into your pension, but there is a limit on the amount that you can contribute that will benefit from and attract tax relief. This is known as your annual allowance. The standard annual allowance is the lower of £60,000 or your relevant earnings. Relevant earnings cover income from employment such as salary and bonuses, and it also includes income if you're self-employed. More importantly is what does not count towards your relevant earnings. So this includes things like rental income, dividend income, and also pension income. If you're employed and your salary is 30k, then your annual allowance would be 30k. If on the other hand your salary was 90k, then your annual allowance would be 60k. Please bear in mind that beyond age 75, although you can still contribute to a pension, you will not receive the tax relief on the contribution. If you have a defined benefit pension, such as the NHS scheme, working out your annual allowance is a bit more complicated than a DC pension. Unfortunately, it's not simply the amount that you and your employer pay in. HMRC have some specific guidance and examples on this, which I'll put into the description. Essentially, you need to calculate the annual pension input amount which your scheme may give you. Now, the trouble with this, though, is that it's backwards looking and it only tells you about the previous year. It is possible to try and calculate the pension input amount manually by calculating the opening and closing balance. To do so, you need the scheme's accrual rate and your beginning and ending salary, and also the rate of CPI inflation. Tina is a member of her DB scheme, and the accrual rate gives her a pension of 1/60th pensionable pay for each year of service. At the start of the year, her salary is £40,000 and she has 31 years of service. At the end of the year, her salary is increased by 5% to £42,000 and she now has 32 years of service. To calculate the opening value, we need to take her salary of £40,000 and multiply this by her years of service divided by the accrual rate. This gives us 20,666. If we then multiply this by 16 and times it by CPI, which we'll assume is 7.9% for this video, this gives us an opening value of £356,789. We now need to work out the closing value for Tina. If we take her new salary of £42,000 and multiply this by 32 and divide it by 60, we get 22,400. We again need to multiply this by 16 to give us a closing value of 358,400. Her pension input amount is the closing balance minus the opening balance, which gives her a pension input amount of 1,611. This means if she wanted to, she could make a gross pension contribution to a DC pension in the region of 38,389. This is her relevant earnings of 40,000 minus her pension input amount. Remember, her annual allowance is 40,000 and not 60,000, as it is the lower of 60,000 or her salary. Now, hopefully that didn't hurt your brain too much. It certainly hurt mine, at least. If you're enjoying the video and you found it useful, please like and subscribe, as it really helps the channel. If you're lucky enough to have a large sum in the bank, or perhaps you've received a windfall or you're due to get a large bonus from work, then it is possible to make a larger pension contribution to your pension. This is known as carry forward. Carry forward allows you to use your unused allowances from the 3 previous tax years as well as the current tax year. Let's see how this works in practice. So Tom's salary this year and the 3 previous tax years has been set at 100k to make things easy. During that time, he's made 20k pension contributions for this tax year as well as the 3 previous tax years. Using this example, he can use the unused allowances of 60,000 for the 3 previous tax years as well as the 40,000 that is unused for this tax year. This means he can make a total gross pension contribution of 100k. Gross basically means after tax relief is added. To calculate what the net contribution would be, simply multiply 100k by 0.8. Don't forget when running the calculation that the annual allowance increased this tax year to 60k from 40k. The calculation can be very complex and there are other rules around this. One of the rules that I often find is so misunderstood is that you must earn at least the same amount as what you want to contribute. So if Tom's income was 70k and not 100k, then the maximum gross contribution he could make would be 70k. You also have to be a member of a UK registered pension scheme, although importantly, it doesn't have to be the pension scheme that you wish to make the carry forward contribution to. If you are retired, you're unemployed, or you're a homemaker, then you have no relevant earnings. However, this does not disqualify you from making a pension contribution and benefiting from that all-important tax relief. The rules allow you to contribute up to £2,880 into a pension. 20% tax relief will be added, which will gross it to £3,600. This is effectively £720 free money, which we find so few people are aware of and don't take advantage of. It's not uncommon for those with savings and an ISA as they approach retirement to then funnel the funds into a pension to ultimately benefit from this free money. We also often see a spouse or partner who is the breadwinner make this contribution on behalf of the other spouse or partner who may be raising a family. You can also make this contribution towards your child's pension with such a long investment horizon. By just making this contribution for a few years or even a much smaller amount can really add up and be powerful over the long term. However, you have to bear in mind that if you make this contribution for a child, it could be 50 odd years before they ever get to see the money. You could say this is a good thing, as it would stop them blowing at a young age on things like cars. However, on the other side of the coin, you could say it could deprive them of capital at a time when they need it most, such as trying to get on the property ladder in their 20s. Alternatively, you could say you need to focus on your own retirement before even looking at your child's. If you take flexible benefits from your pension, then you will trigger what's known as the money purchase annual allowance. This means you can only then put 10k into your pension. This rule exists to stop people simply taking money out of their pensions and making a contribution, again, to benefit from the tax relief once more. If you only take your tax-free cash or you're in receipt of defined benefit or annuity income, then you're free to contribute up to the normal limits. If you run your own business through a limited company, then paying into a pension from the business can be a very tax-efficient way of extracting the profits from it. The contribution can reduce the company's taxable profits, which in turn reduces the corporation tax bill. If your spouse or partner is involved in the business, then it may be possible to make an employer pension contribution for them as well. For the contribution to qualify as an allowable expense, it must pass the wholly and exclusively test. If you are considering a contribution from the business for either yourself or your partner, then it's very important you check this with your accountant. You don't want to avoid falling foul of HMRC. If you're lucky enough to have an adjusted income above 260k, then your annual allowance will be reduced for £1 every £2 that is over this threshold until you have the minimum tapered annual allowance of 10k. If you fall into this category and you're looking to make a pension contribution, it could be a good idea to seek professional advice, particularly if you're thinking of doing a carry forward contribution as the limits changed last year. I hope you enjoyed this video. I've also got another video which looks at how much you'd need to retire and how you can see if you're on track with your own retirement goals.